Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research Global Markets EMEA and International Securities. It's Friday the 14th of March 2025, and joining Derek to post some questions on the financial market themes for the week ahead is Simon Mays, Head of UK, Ireland and Switzerland Corporate Sales. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hey, Derek, great to see you. How's your week been?
And you, Simon? Yeah, not too bad. Busy as usual. Trump keeping us busy every day of the week.
Yeah, it's definitely been an interesting one. I wanted to start, that's a good place to start really with the US dollar. It's a bit of a two-part question, I guess. This is the first week for a little while we've seen some dollar consolidation, I guess, after some quite intensive selling in recent weeks. So firstly, I also wanted to get your view on what you thought the reasons for that were. But then at the end of the week, we've started to see a bit of a dollar sell-off again. So second question, I guess, would be then where does that leave us for next week?
Yeah, I think obviously we had a big move since the German announcement in particular. And I think, there's still a debate, I think, in terms of, okay, I get the fact that the logic has kind of shifted because of the weakness of the US economy, that suddenly tariffs, which, historically and in theory as well, is a dollar appreciation development, but suddenly it's flipped to being a dollar depreciation story. But I don't think that can last indefinitely. I think what's happened in terms of the dollar weakening is that the expectation in terms of the relative impact has changed because of the German announcement, because possibly the China announcement, and then because of the weakening economic data. Investors have just kind of readjusted in terms of what the impact on the US could be versus what the impact abroad could be. So an adjustment, I think, has taken place. So my sense is that, perhaps the consolidation this week was some evidence that maybe we've reached a new equilibrium where markets are in a more comfortable position in terms of assessing the relative impact of tariffs. To your second part of the question, there's still a bit of scope. Obviously, if you get confirmation of good news, so we had the Greens being confirmed as on board in terms of getting a vote through the Bundestag on Tuesday. So the small, modest risk that was there in terms of delivery of that fiscal stimulus program has come down. So that I think prompted some dollar selling. And then, of course, first thing this morning, the Chinese equity markets were outperforming in Asia. So this press conference that we have on Monday, apparently outlining policy can help support consumption. That's obviously given a lift in terms of the potential growth impact from that on China. And again, going back to what I said at the beginning, the kind of relative impact is therefore changed a little bit if they're going to go pretty aggressively with policies to support domestic demand in China. So yeah, it leaves us in an interesting position where ultimately, I feel anyway, if you consider the bond yield move that we've had on the back of the fiscal announcements, to me it feels like in an instant the markets have priced in a lot of the good news in relation to Europe anyway. Now there might be a bit more to run in terms of potentially Russia coming around and agreeing a formal 30-day ceasefire, a bit more progress on that, and there's still a bit more there potentially in terms of good news. But I think the bulk of the move is over in terms of the good news in relation to Europe, and it's going to be a tougher task to say break 110 and advance beyond those levels.
I guess moving away from then the political impacts on the markets, which have been taking precedent recently. We've actually got some monetary policy events to keep us occupied next week, quite a few of them, I think. FOMC, Bank of England, Bank of Japan, Riksbank, SNB, and a few others as well. What do you think will be the standout meetings next week? What should the market be looking out for in those?
Well, I guess obviously always important is the FOMC, although, you know, of all the G10 central banks that you mentioned there that are meeting next week, all Wednesday, Thursday, by the way, so all quite close together. The SNB is the one that's, you know, pretty much close to priced for 25 basis points, which again makes sense given they tend to follow the ECB quite often. So, but apart from that, the rest will definitely be on hold. FOMC, obviously, we've got a bit more details in terms of the summary of economic projections. The dot profile at the moment is 2 cuts for this year, 2 cuts for next year. And we've got a GDP estimate of 2.1% this year, 2% next year, and core PCE projection of 2.5 this year and 2.2% next year. You might get a tweak lower in GDP growth estimates and maybe a little nudge higher in terms of core PCE. I don't think the dots will change. The communications that we've had most recently from Powell is kind of status quo. You know, he spoke this week and said that, you know, the cost of being cautious is very, very low. So why rock the boat? Why change any guidance, like as important guidance in terms of the dots? So our view is they'll probably keep them the same, and the communication from Powell would be pretty close to what we had in terms of his comments of late. So maybe in that context, the BoJ might certainly be an interesting one.
Well, that was going to be my next focus, actually. Looking at dollar yen this week, you know, it's moved higher again this week, but doesn't really look like it's moved in line with the dollar index. So perhaps a more Japanese driven sort of move. So yeah, can you give us a bit of color on that? And do you think this is going to continue, dollar yen higher?
Dollar yen higher, I would be surprised. I think the first thing I'd mention is positioning.
Yeah.
The weekly CFTC leveraged fund positioning, we've gone from the biggest short position, I think, since October to an outright long position. So there's been a liquidation of about 55,000 contracts from a CFTC positioning perspective. So a pretty dramatic turn from the more usual yen short to a small long position. So maybe, and obviously we've advanced further since then, so maybe the positioning got a little bit crowded. We have had a considerable shift in the 10-year JGB, so US Treasury JGB yield spread, down actually from January, down that spread, down nearly 100 basis points.
Wow.
And going back to the global financial crisis, that has not happened very often. And I was doing some analysis earlier in terms of the rolling correlation between dollar yen and JGB yields. And the shift that's been taking place is that's becoming negative.
Right.
So that negative correlation is becoming more of an influence, which is indicative of domestic factors playing a bigger role. Not obviously, it's not the only role, and what happens in the US is important. But when that correlation is strengthening, that tends to be a sign that that's the influence, which often means there's been a breakdown in the correlation between US Treasury yields and JGB yields, which is exactly what happened. That spread has narrowed significantly. So I think yes, domestic policy, the fact that the terminal rate in Japan has shifted again since the beginning of the year, it's gone from 90 basis points to about 120 basis points. There's been a debate, there's been a few comments from BoJ officials in regard to the terminal rate, where that is now. The market rates imply, the forward rates imply about 1.2%, as I said, is the terminal rate. So I don't think Governor Wade is going to get into that in any great detail. But what I think he will do is continue to be confident that they're on the right track, and that will, I think, endorse the market pricing that's in the OS curve for hikes this year, which is basically 25 basis points and then a half of another 25 price by the end of the year. As long as we get that, I think JGB yields can hold up. Obviously, you might get a bit of volatility over 24, 48 hours, but ultimately, I think that'll be the message from Governor Ueda. And I think in that context, assuming there's no major shock from the FOMC, I would imagine that dynamic continues to be supportive for the yen to strengthen. Now, the only other point that quickly I'll mention is this political development today, where, incredibly, given the LDP funding scandal that hit the party, this news broke this morning in Asahi newspaper that the Prime Minister's office handed out 100,000 yen gift vouchers to the 15 new LDP members in the Diet. And that's kind of lit up the whole, corruption within the party type story. Prime Minister Yoshiba has apologized, said there was nothing in it, but, I think the yen selling today may reflect a little bit of political risk premium coming back in. An upper house LDP member called for Yoshiba to resign after the budget has gone through Parliament. So this could grow and it could weigh on the yen. So that's my only concern short term, in terms of the yen maybe weakening more than we anticipate. But I still think the fundamental backdrop, and of course we had the Rengo wages today, higher than last year's first estimate, which is a strong signal that wages continue to be supportive of inflation.
Very interesting. Thanks very much, Derek. Thanks for your thoughts, and have a good weekend.
Okay, and you, Simon. Thanks a lot.
Cheers.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe, and contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets research team.